Okay, great. So let's get going. So my name is Mike Chavez with Veterans Lending Group. I am a licensed mortgage loan originator and a national educator. I love doing the education stuff. I've been with Veterans Lending Group for almost 3 years now, and I do the education stuff full time now. There's my links to all my socials, known as Finances with Mike. And you notice like X and Instagram, the E's missing because I ran out of characters. It's just what it is, right? So there's a QR code. It's to my digital business card. Feel free to click on it. I could even put my contact information in the chat itself. So a little bit more about me. I'm married, got 3 boys. I went to USC. I graduated from their master's program. It's a master's program specifically for veterans and active military. So if you're interested in that, let me know, because it's a 10-month master's program. It's accelerated. It'll melt your brain. But man, then you get a master's from USC. And their scholarship program is second to none. That was a $45,000 degree, but I only had to pay 13 grand. I didn't have any other, all my GI Bill was gone from my undergrad. So if you want to know more about that, I have a YouTube channel called Finances with Mike, where I teach the basics of personal finance, whether it be credit, budget, and things like that. I'm your guy. I'm happy to answer those kind of questions for you as well during the Q&A if you like. I am a real estate investor and an owner. I do short-term rentals, long-term rentals. So if you want to pick my brain about that, happy to do that as well. Just a quick story with the home that we currently live in. We only Airbnb during the summer, and that pays for our mortgage for the entire year. So it's pretty cool. So if you want to learn those kinds of things, I can help you. So I want to just give you an overview of the first home that I purchased using my VA loans. Back in 1995, yeah, I'm dating myself a little bit. I was stationed here in Colorado Springs, and I bought this charming little 3-bedroom, 2-bath in 1995 for $86,900. You can see the image is a little old. I looked it up on Zillow in February and found it's worth around $368,200. Now, granted, that's just an estimate. It could sell for higher, it could sell for less, but just taking that as a baseline, right? If you look at the average annual appreciation of that home, it's appreciated in value almost 6% each year, which is actually higher than the national average of 5.5%. But overall, it's appreciated in value 424%, right? So it's a pretty good investment, right? Now, had I hung on to it, my original monthly payment was $598, included principal, interest, tax, insurance, and HOA. And right now, I looked at what I could rent it for. Had I kept it, I could have rented it for $1,900, giving me a positive cash flow of $1,300 a month. A little lower, well, for a few different reasons, right? One, because tax and insurance will have gone up over that time. If I had a property manager, typically they charge 10%. So those kinds of things you need to consider. But still, it's pretty positive cash flow situation, plus all that appreciation I gained on that property too. Not only that, I would have had paid off that mortgage. So I would have had no mortgage by now had I kept it. But my marriage fell apart, and we moved back to California, things like that. But I just wish I would have held on to this property. So why do we teach at Veterans Lending Group, right? Because these classes are completely free. There's no obligation. We're not going to pressure sales you or anything like that, right? Number one is to close the knowledge gap, because there are so many people that don't know about their benefit or how to effectively use it to meet their goals. So that we're here to close that knowledge gap. And then when it comes time for you, either it's now or years down the line, for when you are ready, when it makes financial sense for you and your family to purchase a home, to help you become your own advocate so that you are armed with the knowledge you need to make smart financial decisions when it comes to your VA loan, or even help your battle buddy in the future. You actually give them advice. So I'm a stats guy, and I looked all this numbers up, right? So out of the 20 million veterans and active service members that are eligible to use this benefit, only 18% are actively using it. And that is a shockingly low statistic. And it saddens me, because the VA benefit is one of the best home loan products there is on the market. But also, there's a little under a third of us that don't even know about this benefit or how to use it, right? So the reasons: the VA has limited resources and time. The benefit actually changed as of January 1st of this year. I'm willing to bet not one of you received a notice from the VA telling you about how your benefit improved, right? But also there's tons of misinformation and outdated information out there, right? I mean, now that information is so accessible to us, there's a ton of misinformation out there, right? Just so you want to go with people that you trust. And outdated information, because this program changes so much over time, what may have been true a couple years ago may no longer apply. But in general, the VA benefit just keeps getting better and better and opening the possibilities of what you can use it for. And then finally, a lot of lenders will actively discourage you from using your benefit, particularly if they are not VA home loan specialists. If they're not specialists in the VA loan and they only do 1 or 2 a year, they're missing out because this program changes so often. Lenders that aren't actively doing VA loans all the time hate doing VA loans because they're a little more work, right? And you have to keep up. So they will actually push you toward a conventional FHA product, even though it may not be the best fit for what you're looking to do. There's 2 sites before we really get into the groove here. One is optoutprescreen.com, and the other one is the donotcall.gov website, where you can opt out of getting like phone calls, mails, all those solicitations. The reason why these 2 are critical, and I could put that in the chat as well. 1 second there. The reason why these are 2 essential websites to opt out of is because once you do a hard pull on your credit, if you're looking to purchase a home or things like that, the credit bureaus will turn around and then sell your information to other lenders. And then you will start getting bombarded with solicitations. You get emails, calls. We've had some customers get up to 50 calls in a day. So if you don't want to get inundated with that crap, you want to sign up for these before you get your credit pull, at least like 2 weeks in order for everything to get into effect, right? So please, please, please do that. It's going to save your sanity. So part 1, so what is the VA home loan benefit? The VA home loan guarantee is the official name of your VA benefit. One thing to note is that the VA does not normally lend money itself. What it does, it provides a 25% guarantee to us, the lender, in the case that you default on your loan. So how does that work? So like, let's say you purchase a home for $400,000 and you've been paying on it for a few years and you had a financial event and you couldn't make the payments anymore and you lose the house. The VA will then turn and write a check to us, the lender, for a cool $100,000. Now, it doesn't matter how much is remaining on the loan. It's all based off of the original loan amount. So you could own like $25,000 left. It doesn't matter. They would still cut a check to us for $100,000, and then we can resell your home, right? So why do they do that? They do that as an incentive for lenders to offer the VA loan as an option, right? So it lowers our risk by offering you that benefit. Now it's a lot more work, and that's why a lot of lenders steer away from the VA home loan benefit. So you want to work with a VA home loan specialist, even if it's not with our company. Just keep that in mind. Now, if you think that you qualify for the Native American Direct Loan, it's a product, the one product where the VA will lend money directly. And this is super awesome because those interest rates start at 2.5%, not the 6.5% to 7%, what's currently on the market right now for VA loans. 2.5%. You can't touch that unless you assume someone's on loan, right? So if you think you may qualify, check that out, reach out to us, and we can help get you connected to the right people on that. VA does have a funding fee. It's a one-time fee that they charge every time you close on a loan. The VA funding fee is used to fund this program. It's completely self-funded, meaning that there's no taxpayer dollars that go toward this program, which is why it's super awesome, right? It's self-funded, it's self-sustaining, and that's what your VA funding fee is going toward, right? And here's the different amounts of that fee depending on whether it's your first time use or whether or not you put down a down payment, and the numbers will change a little bit. One thing to note though, with that funding fee, it can be waived if you have a disability rating of 10% or more. I have a disability rating of 80%, but 10% could be something as easy as tinnitus or tinnitus. It's one of the most easiest claims to get approved and the quickest. You know, I got mine approved, like it only took like 6 weeks or so. So if you have any physical or mental conditions that were caused or aggravated by your time in service, go see the doctor, go file your claim, get your disability, because once you get that rating, you are exempt from paying that funding fee for life. It's pretty awesome. So you could save thousands, tens of thousands, in some cases, hundreds of thousands of dollars by avoiding having to pay that funding fee with your disability rating. Also, if you are a Purple Heart recipient or a Gold Star spouse, and I get into what that is in a little bit, you will also be exempt for life for that VA funding fee. The VA does require that you intend to occupy that property as your primary residence. Now, that's the language, intend to occupy. The VA understands that everyone has their own unique circumstances, right? So the VA is pretty flexible and willing to work with you, but it is intended to be a program to put veterans in actually homes they're going to live in, right? And also, you must occupy within a reasonable time. That's the official wording. That reasonable time is also flexible, right? But typically they're looking like, as long as it's under 60 days, it's really not an issue. If it's longer than that, usually you'll need to explain to the VA what the delay is. If you are active duty, let's say you're living overseas, you can actually have your spouse or adult child satisfy that occupancy requirement. You can buy a home if you can move, and like if your family is still in Georgia while you're overseas, they could buy a home and they could occupy it on your behalf. So, but if you're looking to purchase, if you don't have any other loans and you're looking to purchase, that county loan limit doesn't even apply. One of the biggest loans that we've done, I think Brooke told me the other day, was 4.9 million. So as long as you could credit and income qualify for a loan of that amount, you could buy a home of that size with no money down if you don't have any encumbrances on your benefit. And I'll get into what that is in a little bit too. Wow, this is 100% VA home down guarantee with 0 to, yep, I know, pretty awesome, right? So the loan can be structured in 4 different primary ways. The first is the easiest for us. It's just where the veteran, him or herself, applies by themselves for that loan, right? We just use their income, assets, and credit to qualify them. The other one is the veteran and the spouse, where we now can take the spouse's income and credit to help qualify for the loan, particularly if they want like to qualify for a bigger loan for a bigger home, right? The third loan structure is the most interesting to me. It's the veteran and the veteran. What's unique about this situation is that these veterans do not have to be in any kind of romantic relationship. It could be just 2 E6s living on base and they're sick of it, right? So they can start their real estate empire. Let's say they buy a 4-bedroom home, right by base. They rent out those other 2 rooms and then use those rents to pay their mortgage. It's like, there's so many ways to hack this. It's ridiculous, right? And then the fourth option is the veteran and the non-veteran. This is not an option that's offered by very many lenders, just so you know, because in this situation, that non-veteran is also not a spouse. So the VA will only cover half of their normal 25% guarantee in that situation, meaning that that veteran, non-veteran need to come to the table with 12.5% as a down payment to cover that other half. And I mean, come on, one of the biggest reasons to use the VA loan is the no money down aspect to it, right? So now if you have to come up with 12.5%, whereas conventional is as low as 3%, FHA is as low as 3.5%, 12.5% is a significant amount. So that may be a reason to either get married before you buy the home, or start with an FHA or conventional, then refinance to a VA loan once you are married, so you don't have to pay that private mortgage insurance, right? So what can you finance? The great thing about this is that the VA has been expanding what you can use the VA home loan for. I mean, barndominiums are a relatively new thing too. They do have some minimum requirements. As long as that home is above 400 square feet or more, you can use the VA loan. So if it's below that, you won't be able to use the VA loan to buy that house. So for most tiny homes that are usually they're far lower than that 400 square feet, you won't be able to use the VA loan for that tiny home. But you can buy a single family. You could do multifamily up to 4 units. So duplexes, triplexes, fourplexes, all game you can buy with a VA loan. And what's great about that scenario is you can use, you're living in one of the units, right? But then you can use the rents from the other units to help you qualify for the loan. How does that work? Simple case, right? Your mortgage is $4,000 a month. And you can rent out each of those other 3 units on that fourplex for $1,000 a month. We can use 75% of those rents to help offset what you would need to qualify for that mortgage. So $3,000 total for those other 3 units. We use 75% of that, or $2,250. I hope I have my math right. We can subtract that from what you would need to qualify for that loan amount. So it's pretty awesome. And then now you have income property, right? You're generating income on the property. In some cases, you may even come out positive, meaning that those rents could fully cover what your monthly mortgage payment is. We could do condos and townhomes. We could also do manufactured homes. But one thing to note about condos is that they need to be on the VA approved list. If they are not on the VA approved list, we can help you get that unit on that list prior to closing on that loan. When it comes to manufactured homes, there are some restrictions. It needs to be built after 1976. It needs to be on a permanent foundation. It needs to have its HUD tags, and all the septic needs to be pass inspection, things like that. And there's a few other requirements, but in general, we could do manufactured homes. But the most interesting to me is now we can do custom construction, meaning that now you can purchase land and pay for all the improvements of all that construction on that property all into one loan. It's called the VA one-time closed construction loan. There's been an explosion of interest in this program because, like a lot of you may live in areas where the cost of houses has just skyrocketed. Cost of construction has actually come down after supply restrictions from COVID, right? Now we'll have to see what how the tariffs impact construction costs, but right now they're still relatively reasonable. And by doing it this way, one, you can get a bigger lot, because I don't know if you noticed, but all the new construction nowadays seems to put like these big houses on these tiny lots, right? So where you can open your window and you can touch your neighbor. If you want a little more privacy, it's better to pick the land of where you want to live than build on that land. Then you can have as big an acreage as you want, right? And what's relatively new is you could even use that one-time construction loan to build a multifamily property. So you can build up to a fourplex as a single veteran. And if you're a veteran and a veteran, you can build up to a sixplex. So 6-unit homes, right? So that's something that's exploding in popularity. If you want to know more information, put that in the chat and we can hook you up. Here are some costs for custom construction, just so there. Right now, the limits, actually these limits are old. Instead of 766, it's 806, 500. So up to 806, 500, you would need a minimum FICO score of at least 620. You could borrow 100%, and max DTI, you'll get into what DTI is in a little later, at 50%. And then there's a breakdown for the others. So as long as it's below $1 million, you can have no money down. Once you go above $1 million, it's usually a minimum requirement of 5% down. So just be aware of that. But usually, if you could qualify for a home that's worth more than $1 million, usually you would have money set aside to put 5% down, right? And the minimum total loan amount for this program, the one-time closed construction loan, is $100,000. Which is usually pretty easy. Sometimes the land itself is worth at least that, right? When it comes to VA appraisals is something that the VA requires to be done on the home prior to buying. It's going to look at the fair market value of the property to make sure you're not overpaying on a home. And it's going to look at 3 different factors: safe, sanitary, and sound. It needs to meet all the local and county structural safety building codes. And because of this, you may be able to use the VA loan to purchase a fixer-upper, as long as it satisfies those minimum property requirements that the VA appraisal will do on either a safe, sanitary, and sound. So if it's like cosmetic things like paint and carpet, or you want to upgrade to like a chef's kitchen or something, usually that's not a problem, right? But if there's like structural issues, foundation issues, safety issues, those will need to be remedied prior to closing on the loan. And because this program is designed to put veterans into homes, house flipping isn't allowed unless you're looking to buy and hold for at least a year or so, right? When it comes to VA loan eligibility, who's eligible? If you served in any of the branches as active duty for at least 90 days or 180 days, if you're in the reserves or National Guard for at least 6 years, and some other little requirements. But however, if you were in the reserves or National Guard and you've been activated for at least 90 days, you don't have to wait that full 6 years. You just wait until you've served that 90th day of active duty service. It's pretty cool, right? It's a nice little shortcut that's actually relatively new as well. Or if you're a spouse of someone who was missing in action or POW, or if that veteran dies in service or from a service-connected disability, you would then be eligible to use the VA funding fee or the VA home loan. And you would be exempt from that VA funding fee as that spouse. So one thing to note is that your eligibility never expires. This is also something that's not relatively new, but has not always been the case, right? But now you can use your VA benefit over and over, and you can have more than one VA loan at a time. The record, I believe, with our company is 4. We've helped a service member obtain their 4th active VA loan, and we'll get into strategies on how to do that. Certificate of eligibility. This is your ticket to the show, right? We can pull this as quick as a couple minutes, completely free, because it will tell us if you're eligible to use the VA home loan, and if you've used it before, if you have any encumbrance on your entitlement. This gives us all the information we need in order to determine your ability to use the VA loan. So where can you use this benefit? You can use it in all 50 states and all US territories. So all those little islands out in the Pacific, you have Puerto Rico, you can use it. With Veterans Lending Group, we serve all 50 states and we do Puerto Rico. We don't do all the US territories. It's just cost prohibitive for us to do that. But we can hook you up for any of those locations. So why should you use it? This is my favorite section. So the VA loans are more lenient than any other loan program out there. They're either lowest or tied for lowest from the amount of time it takes to recover from a financial setback, right? So Chapter 13 bankruptcy, you only have to wait a year to be able to use your benefit again. Other programs like conventional, double that. When it comes to like Chapter 7, short sale, foreclosure, you only have to wait a minimum of 2 years. With conventional, like let's say you had a foreclosure, you'd have to wait 7 years in order to be able to use buy a home with a conventional loan. With VA, it's only 2. One thing to note is that judgments and liens must be paid off prior to closing. There's no exceptions on that. But if you had collection accounts on your credit, in most cases, it makes more sense to leave them alone. Here's the reason. I'm going to put on my financial coach hat for a second, right? So I'm all about credit. I'm going to teach you some things about credit. If you have a collection account, it will significantly hurt your score. We all know that, right? But as time goes on, the older that collection account gets, the lower it's going to impact your credit score negatively, right? So you're actually see an improvement in your score over time, because as that account ages out, it's going to impact your credit less and less. So let's say you had a collection account that's been dormant for 4 years, right? Normally, collection accounts will remain on your credit report for 7, and then it'll drop off. If you were to make a payment, let's say you made $1 payment, instead of that account being 4 years old, it's today years old, meaning that now not only is it going to remain on your credit report for another 10 years, instead of just the remaining 3 had you not touched it, but because it's today years old, you're going to take a bigger hit on your credit score, which may disqualify you or may have negative consequences when it comes to qualifying for a loan. So be very, very careful before you start making any payments toward any of your debts. Talk to a VA home loan specialist first. Talk to a lender about whether it makes financial sense to do those kinds of moves, and we can help you navigate that so that you have the biggest impact on your credit score instead of just trying to do it blind. So be very, very cautious of that. So another why use the VA home loan? One, it's easier to qualify. The VA has very low requirements compared to other loan programs and what they will accept when you apply for a loan. There's no down payment on almost all VA loans, And the VA does limit the amount of closing costs you, the buyer, can actually pay. There's no private mortgage insurance like conventional and FHA would have. Conventional, if you put less than 20% down, and FHA, you're going to pay that regardless. They do have that VA funding fee, but note that funding fee is a one-time fee, and you could roll it into the loan. So that $400,000 home I was talking about, if that VA funding fee was $8,000, you would just roll that into the loan, so your loan amount would be $408,000. It's a lifetime benefit. It never expires, like we mentioned earlier. Once you're qualified to use it, you have it for life. You can have multiple loans, either sequential, one after another, or simultaneous loans. There's faster recovery from financial setbacks. Remember the foreclosure, short sale, bankruptcies? It's only take you 1 or 2 years to recover to be able to use the VA benefit again. There's no minimum credit score. Now, you may say, what the heck? My lender told me I didn't qualify because my score was below 580, below 620, whatever. That is what's called an overlay on the VA's requirement. The VA itself does not have a minimum credit score requirement. The lender has a minimum credit score requirement. They do that to protect their shareholders or the owners of the company. They're limiting their risk by reducing the amount of loan or amount of people that would otherwise qualify for a loan, right? So work with a VA home loan specialist that does not have a minimum credit score overlay. And we have Veterans Lending Group. We do not have a minimum credit score requirement. We go off the VA guidebook. And then lastly, multifamily investment opportunities. Like I said, if you're just a veteran purchasing, you could purchase up to a 4-plex. If you're a veteran, you can purchase up to a 6-plex. So there are ways that you can start your real estate empire on your first purchase. There is no minimum credit score requirement with our company. The lowest score we've actually had approved, I believe, is 507, and that's significantly low. Now, note the reason why typically, if you have a score lower than that, the biggest challenge that we run into as a lender is that the VA also has a requirement that while they don't have a minimum credit score requirement, they do require you to have a clean credit history of at least 12 months. So if you have late payments that are actually pulling down your score, usually if you have a score that low, it's because you have late payments, it's because you have judgments, it's because you have collections, things like that, right? So charge-offs, things like that. So if any of that is within the last 12 months, that could prevent you from obtaining a loan right now. When it comes to rental or mortgage history, they're going to look for 24 months, not just 12 months of that. So there are certain accounts that you want to make sure that you're paying on time. You may have stepped on it in the past. I understand it. Everybody has their struggles, right? What matters is what you decide to do today, right? So recover from it. Make your minimum payments on time, right? That's the biggest thing that you could do to help yourself to qualify to obtain a home loan, whether it's VA or any other loan product, right? You want to protect your score. So just because it does not have a minimum credit score does not mean your credit score isn't factored into what you qualify for. So by having a low credit score, even though you won't get it just automatically denied with like a conventional, but you would pay higher interest rates. Here's the deal. When it comes to credit score, your target should be at least 740, because at 739, you're going to take a credit score hit, meaning that let's say you would have otherwise qualified for an interest rate of 6.5%. Because your credit score is below 740 and the 739, you're going to take a hit. So instead of 6.5% interest rate that you would get, maybe it's 6.65, right? And that difference could mean you're paying more in interest and less on principal, which translates to lower purchasing power, right? When you buy a home. So be aware of that. And then for every 20 points below 639, you're going to take another credit score hit and another, right? So if you had a score of like 650, you're going to take multiple hits, meaning that instead of that interest rate of 6.5 that you would normally get with the good credit, now you may be in the low 7s. So be very, very careful with that. Also, it can lower your debt to income ratio. Now, when it comes to debt to income ratio, this is where I'm going to start getting into a little more financial talk. Debt to income ratio is what we're going to use to determine how affordable this loan will be for you, right? So I'm just going to give a simple case. Let's say your gross income was $5,000 and you didn't have any other debts and you're looking to purchase a home, and we could qualify you for, let's say, 50% debt to income. What we're going to do is take half of your total gross, 2,500, divided by your total gross, right? So that's 2,500 over 5,000, that's 50%. That's the largest monthly mortgage payment that you can afford at 50% DTI. Now, if your credit score is low, we may have to lower that threshold. So instead of 50%, you may go down to 40%. So instead of affording a $2,500 payment, you may only be able to get approved for a $2,000 a month payment. That could be a difference of around $75,000 in purchasing power, which may affect the neighborhood that you're looking in, right? Or even the model home that you want, right? So even though credit score, you can't get denied based on your credit score, you'll be only approved for a smaller loan amount. So be aware of that as well. And because of that lower score, we may ask that you have some compensating factors, meaning cash on hand, either for reserves, or you can elect to put down a down payment that lowers your risk in the eyes of us, the lender, when you go to purchase a home. So county loan limits. This is one of the reasons why your benefit improved as of January 1st. Last year, the county loan limits ranged from 766 to 1.149 mil. And now they're up to, at the minimum, 806, 500, all the way up to 1.2, like that county that was mentioned earlier. When these come into play is if you are a partially entitled veteran. If you have no encumbrance, there is no upper limit to what you can qualify to purchase. One of I think the record at Veterans Lending Group was 4.9 million. Obviously, that a veteran did very well for themselves post-service. They just income and credit qualified for a loan of that amount with no money down. Pretty awesome. So I'm going to do an entitlement comparison between whether you're partially entitled or fully entitled. If you're fully entitled, it means that you don't have any current VA loans or you've never even used the VA benefit before. There is no upper limit on what you could purchase for no money down. Partially entitled means that you've already used the VA loan and you currently still have that VA loan, or you may have paid it off or refinanced to conventional, but you still own the property, right? So in that case, it's still going to be what's called an encumbrance on your entitlement, which will have the county loan limit apply. So how does that work? Let's say you purchased your original home for $500,000 and you're looking to buy your second home, let's say here in Colorado Springs, where the county loan limit is 806, 500. That means you would have $306,500 remaining of your benefit to purchase a home here in Colorado Springs. Doesn't matter where your original house is. It all depends on the county loan limit of where you're moving to, right? So as long as that second home that you're looking to purchase is at 306,500 or below, you could buy that second home for no money down. If, however, that second home is above that, let's say, for example, it's 406,500. Now you've gone $100,000 above that county loan limit. The VA will require you to come up with a down payment of 25% for that overage. So 25% of that $100,000 overage is $25,000. They want you to come up with $25,000 as a down payment to purchase that $406,000, $500 home. Any questions on that? Happy to answer. So you can restore your entitlement in two main ways. One is the traditional method. This is when you pay off the VA loan and you dispose of the property. Typically, that's just when you sell the home, right? When you sell the home, your VA loan is paid off. It frees you up to buy your next home. You can do that a limited number of times, over and over and over again, right? You can also request from the VA what's called a one-time restoration of your benefit. Now, the key word is one time. You could do it once in your life, right? You fill out a request for a one-time restoration to the VA. What they will do is they will restore your entitlement. So even though you still have a VA loan, you're still paying off that VA loan. You either refinance a conventional or just pay it off, but you still own the property. What they will do is they will remove that from your certificate of eligibility, which I showed you earlier, meaning that you could buy your next home for no money down, regardless of the purchase price. You can do that once in your lifetime, so be very strategic about when you want that to apply for you. Also, when it comes to assumable loans, have really exploded in popularity because interest rates have been going up, right? Right now, VA loans, they're around 6.5%, 7%. But I refinanced my VA loan to 2.75% just a few years ago. And, you'll touch that. So one of the ways that you can obtain that loan is by assuming an existing VA loan from someone else, right? So the way that it works, it puts you in an advantageous position as a veteran buyer, because if you were to assume a loan from a VA seller, basically that entitlement just shifts from that seller to you, the buyer, and it frees that seller up now to purchase their next home for no money down. If, however, a non-VA buyer takes on that loan, they'll be responsible for the loan, but the entitlement stays with the VA seller, meaning that the county loan limit is going to apply for the next home that they buy, and they may be required to have a down payment. So it's in the VA buyer's best interest or VA seller to sell to a VA buyer to free up their entitlement. So that puts you in a better position than your competition. That's number one. That's a great thing, right? Number two is that you have to consider the difference between the sale price and what's the amount remaining on that loan. Let's say they're selling for $500,000, but there's only $400,000 remaining on their loan. That gap, that difference of $100,000, you're going to have to come up with either by paying in cash, like a down payment, getting a personal loan, something like that. If you were to get a second loan, those second loan rates are usually really high. So we can do the math for you to see if it makes financial sense to finance that difference. In most cases, it won't, but it may. It may be challenging to find a lender that's willing to do that deal for you. In which case, it may just be cleaner to just buy it outright and then just refinance when rates drop, right? It's not going to drop to 2.75% anytime soon, if ever again. So, but you can get a better deal. And we could discuss scenarios if you want. So paying for closing costs. Just because there's no down payment requirement does not mean there are no closing costs. Think of it this way. Down payment is essentially putting instant equity in your home, whereas closing costs is paying all the third parties that are involved in this transaction. So lenders, realtors, if you use them, inspectors, appraisers, title, escrow, all these people are helping close the deal. They all need to get paid. It's their job, right? So these fees are split between the seller and the buyer. So when it comes to the buyer portion, there's a few different options. You can pay out of pocket. Typically, it's anywhere from like 1% to 3% of the purchase price, right? So just be aware of that. You can receive a gift or grant from a family or a close friend, as long as it's a true gift or grant, meaning that there's no expectation of repayment. We're going to need a letter from the person giving you that money stating as such. You can receive a personal loan like we talked about. You can actually get a loan to pay those closing costs. However, keep in mind that now it's a new debt, right? So that can negatively impact your credit score, and that minimum payment will be counted against your purchasing power. And then you can also negotiate in the purchase price, and I'll show you how to do that in just 1 second. So the seller can actually pay your portion of the closing costs. They have a few different options. They could do it out of the kindness of their heart. They could pay all of it or a part of it, or they can negotiate in the purchase price. How does this work? Let's say you had your eye on that $400,000 home that they're selling, and your closing costs is around $8,000 or 2% of that, right? If that home could appraise for at least $400,000 to $8,000, what you can do is you can offer the seller $408,000 and ask the seller to put that extra $8,000 toward your closing costs. You're essentially financing your closing costs into the loan. And that's a great option if you are really strapped for cash and you really don't have that money to pay those closing costs. You could finance it. When it comes to seller contributions, each program has limits on the maximum amount that the seller can contribute toward your closing cost. The VA has it broken down in 3 main categories, and I won't get into all the minutia here. You take a screenshot or whatever, or we could talk about it later. But the VA is the most generous of any other program in the amount of seller closing costs they can pay. When it comes to refinance, there's two different main options, right? You can refinance like a regular conventional loan to a VA. You can do a cash out refi where you're actually just pulling out equity to spend on whatever you want. If you put it back into your home though, like if you're doing improvements, that money can be tax deductible. You talk to your tax specialist, things like that. Or you can write it off right at the end of the year. Or you could do what's called a streamlined refinance. It's called the interest rate reduction refinance loan, or ERL for short. And what it does is it basically you're just locking in a lower rate. It's super easy to qualify. There's minimum documents. You don't have to re-qualify for the loan. Because think of it this way. You already qualified for a loan at a higher monthly payment and higher interest rate. All we're doing is lower your interest rate and lowering your payment. So if you qualified for the worst loan, you're already paying on that and already have a history of doing so. There's no reason to qualify for a better loan, right? So it's super, super quick, it's super easy, and they only charge you 0.5% for the VA funding fee if you are not exempt. So it's a great option. So I'm a numbers guy. I kind of wanted to show you this. I pulled this up from the US Census Bureau. Median sales price of homes sold all the way back from 1963 to the middle of last year. If you were to average it out, you see on this green line, it averages out to about 5.5% average annual appreciation. This is for every home in America, from 1963 to present. Now, I understand every market is different, right? And depending on the type of home, like manufactured homes and mobile homes appreciate in value far slower than a typical stick-built house. Same thing with like condos and townhomes, right? But in general, 5.5% average annual appreciation. The reason why I'm going to show you this because I want to do a rent versus buy scenario. So taking that 5.5% average annual appreciation, comparing to the 3.7% average annual rent increase, and this is something I've also looked up. I think I have that. Oh, that was from the St. Louis Fed as well, at the US Census Bureau. I'm going to do a scenario. So on a $300,000 home, say it was a 6% fixed rate, $10,000 down. Your monthly mortgage payment, including principal, interest, taxes, and insurance, here in El Paso County, so I could calculate these numbers, $2,000 a month. Rent starts off at $2,000 a month as well. So your starting point is the same. Now we're going to extend that over the next 10 years. Over the next 10 years, if you were rent, you would have spent $284,000 in rent over that 10 years, and your rent has gone up 40% during that period because it's cumulative, right? So it goes up to 2074, and then the next year, it's 3.7% of that 2074. So it's just going up each year all the way to 2774 a month, almost $3,000 a month. Then you compare that to the mortgage, right? The mortgage has gone slightly up because your taxes and insurance will almost definitely go up each year, but it's not going to go up as much as your rent. So over that same 10-year period, you're spending just a little over $250,000 over that 10 years. Your payment's gone up 9%, which means a pure cash flow savings of $33,000. Now, that's not a ton of money, right? But here's where the difference really kicks in. During that 10 years, you've paid down $47,000 on what you owed on that principal, meaning that's just now equity that you're building in your home. Plus, because of that 5.5% annual appreciation, your home is appreciated in value over $200,000, giving you a little over $250,000 of equity in that home. So if you combine that equity to that cash flow savings, you've generated over $285,000 in wealth by buying over renting. Now that to me is just amazing. I freaking love this slide. There's also tax incentives for owning versus renting, right? You can deduct your property tax, you deduct your mortgage interest. If you have a disability rating 100% permanent total, you may be tax exempt from paying either property taxes completely or partially, depending on which state you live in. There's also tax-free profits. This is something that my wife and I have taken advantage of a couple of times. If you were to sell that home, up to $250,000 if you're single, and up to $500,000 if you're married, you don't have to pay any taxes on that income. Now, for John Q. Public, for those of us that are working for the man, either salary, hourly, even commission, there are not many tax breaks that we get from the government. If you're a small business owner or if you're on the top, 10%, there are tons and tons and tons of things that you can write off in tax breaks, right? But for John Q. Public, we don't have a lot. This is one of, if not the best tax breaks you can get as John Q. Public. And it's something that I've taken advantage of, and it's something that is a great benefit to you. One caveat is that you must have owned and lived in that property for a minimum of 2 of the past 5 years in order to take advantage of that tax-free profit. So here's another example. This is a property that I I bought in 2000. It was built in 1972, so it was built before I was born. I paid $89,500, is shown right here. It's just a small condo in Southern California. I looked it up on Realtor.com a couple months ago. Estimated home value of $502. And again, right, like it's estimated value, so it could sell for higher, it could sell for less, but just using this as a base. Over this period, I would have paid $62,000 in reducing my principal and what I owed on the loan. The home is appreciated in value over $412,000, giving me almost $475,000 in total equity in that home. So that averages out to about 7.14% average annual appreciation, which is significantly higher than that national average of 5.5% I talked about, even though it's a condo. But I mean, location, right? That's like when it comes to real estate, it's all about location. But on top of that, oops, I don't have it here, but I currently rent out this property $2,350 a month. Now, I had refinanced during that time of owning it, and my current monthly mortgage, including principal, interest, tax insurance, and association fees, and property management fees, is about $1,200 a month. So that gives me about $1,150 in pure profit cash flow every month on top of the equity that I'm generating. This is a cash cow. This is the one that I have the 2.75% interest rate on. I can't get rid of this property. I'm keeping this till I die because I'm never going to have a situation this sweet again, right? To 2.75%, such a huge positive cash flow situation. I also want to do a comparison. This is why the VA program is so much better than like conventional. And this is a benefit that you earn through your service. So I did this in the middle of last year when rates are higher, right? So for this person, they're looking to buy a $500,000 home, 690 FICO score. So not great, but not terrible either. At that point, they qualified for a rate of 8.625, a conventional loan. Down payment, the minimum 3%, so $15,000 down. There's no VA funding fee because it's not a VA loan. So the total loan amount is $485,000. That translated to a principal, interest, tax, and insurance, again, here in El Paso County, so I could calculate tax and insurance, about a payment of $4,200. But on top of that, because of their low FICO score, their private mortgage insurance is almost $500 a month. So if they were to add that together, their total monthly payment is around $4,700 a month, right, for that $500,000 home. If they were to make their total PMI payments until the time where they would no longer have to pay private mortgage insurance, they would have paid over $77,000 toward that private insurance, which only benefits us, the lender, not that buyer. Now we'll compare that to VA. The VA, that same person qualified for a rate of 7.25%, no down payment. Their VA funding fee was $10,750, but that was rolled into the loan. So their total loan amount was $510 and change, but their principal and interest, tax, and insurance payment was only $3,900. Because there's no private mortgage insurance, that's their total monthly payment. So on a monthly basis, they're saving $734 over same product for conventional. Not only that, if you multiply that, that's over $8,800 annually, right? And if you think about the break-even point, it would take them about almost 15 months to break even from paying off that VA funding fee, and then they're ahead of the game, right? Whereas if they're looking at how long it takes to break even with that conventional, it would take them 13.17 years or 158 payments making those conventional private mortgage insurance payments. Horrible, horrible. So this is why the VA loan is so much better. Now, I want to be fully transparent, right? When it comes to lender fees, I want to break them down and where they go so that you can know what to expect when it comes to you purchasing a home. So the first thing is when it comes to the loan discount, the reason why I say you decide is because there are going to be 3 different scenarios, right? There's going to be a list of rates. There's what's called the par rate, which is a rate that you can get at no cost to you. And then there's 2 scenarios. I'm sure you've heard of the ability to buy down your rate. It's where you're putting money toward just lowering your interest rate. The more money you put, the lower your interest rate. The reason why people like to do that is because it lowers their permanent interest rate, meaning that not only is their monthly payments lower, but their total interest that they're paying over time is lower as well. And then there's a third scenario is where you can elect to actually choose a higher interest rate. Now, I wonder if anyone could put in the comments, why would anyone choose a higher interest rate if they didn't have to? Well, think of it this way. Let's say you were very strapped for cash and you didn't have money to pay all your closing costs and the seller was unwilling to pay your closing costs. If you took a slightly higher interest rate, you get a credit for taking that higher interest rate. And the higher you go, the more credits you get, which you could then use to apply towards your closing costs. So it's a great way. You're basically financing your closing costs with a higher interest rate. So it's not a great, but it is an option for someone who is seriously cash strapped and just can't afford the closing costs. So the next 2, the appraisal fee and the funding fee. These are 2 fees that the VA determines, and so the lender has no control over, right? So the appraisal fee goes straight to the appraiser, and the funding fee goes to the VA. This is where we start getting into what the lender is going to charge you as a profit to the company. Loan origination fee. Most lenders will charge around 1%. So if your loan amount of $500,000, that's $5,000 right there, right? Then they have all these junk fees, right? Application fee, underwriting fee, processing fee, all that stuff, right? If you were to add them all together on that same $500,000 or a home, that could be around $7,100 going to the lender. Just that's what they're charging you for that loan that you qualify for. One thing with Veterans Lending Group, we have never charged junk fees, and we used to only have a flat $9.95 fee for VA loans. But as of the beginning of 2024, we even got rid of that. So we're happy to say that we do not charge any lender fees for VA buyers. Why? You guys are our bread and butter. Over 80% of the loans that we do are VA. And so we always rack in our brains as how we can serve our community, right? Our veterans, our service members. So this is something that we've done in order to make us not only more competitive, but to serve you to the best of our ability. So I also want to give you a little bonus here. I want to show you how to compare deals from different lenders. Again, 100% transparency, right? We're going to try to meet or beat everything. We're not afraid to get competition, and we're going to do everything we can to do you right. So this was the example, right? The sample rate and cost. The no cost rate in this example would cost you nothing, 5.75, right? If you wanted a lower rate, then the cost of that would go up as you get lower. In some instances, you might find a sweet spot right here at 5 would actually cost you lower than at 5.25. It happens. It gets a little complicated, but there are some low spots, and we can look out for those for you. And then if you wanted to take a credit that you could then use toward your closing cost, you could take a higher interest rate, and you can see some of the benefits here. When it comes to a deal, so this is a VA lender competitor of ours. I looked this up last year, and I saw what they were offering, right? They had a promo going. So they're offering a rate of 6.125% for a cost of almost $5,000. But what they didn't tell you is that they have a lender fee of $3,500. So your actual cost for that rate is just shy of $8,500. So I said, okay, can we do better? So I did that same client. They would qualify for that rate of 6.125. It would cost them just shy of $7,000 in points for us. But because we don't have a lender fee, that's their total cost, saving them about $1,500 a month, or $1,500 in closing costs or fees, right? So their fee, their principal interest would be about $1,800. So then I started thinking, okay, well, if they're willing to spend that $8,500, where can we get them? So I looked at it and it would lower them to just 1/8% down to 6%. And cost savings really is negligible at that point. But here's the point. Here's the difference. It would take them 5.5 years to break even for paying that extra money to get that interest rate lowered 1/8%. What does this mean for you? If you were looking to either refinance or sell that home prior to that break-even point of 5.5 years, you're actually losing money by taking a lower interest rate than just taking the standard interest rate of 6.125. This is why it's super important that you work with the lender that you trust, that will listen to what your specific situation is, so that they can advise you on which avenue would fit your future goals. Super important to talk to someone that you trust, because then they could give you all those options and walk you through the pros and cons of each. Here is an example of a loan estimate. This is something that you by law are required to receive, or you're not required, you will receive when you go under contract. After you make an offer and it's been accepted, you go under contract. The lender will provide you with this loan estimate, will give you a complete breakdown of all the fees, all the terms of the loan, like your interest rate, your monthly payment, things like that, and our best guess of what these fees are going to be. And this is what you're going to use to compare lenders. If you decide to shop lenders, like I said, we're not afraid of competition. You go somewhere else, send us your loan estimate and we'll see if we can beat it. But I want you to be able to understand what these sections are. When it comes to basically not only the prepaids and the escrow payments, but basically everything other than this section, you could essentially ignore, because these fees are going to be the same regardless of who you go with. Your homeowner's insurance, you choose your homeowner's insurance, who you're going to go with, right? So it doesn't matter which mortgage company you go with, your homeowner insurance is going to be the same. Property taxes, the same thing. Doesn't matter who you go with, your property taxes are going to be the same. That's for the government, right? So I wouldn't focus on these. What I would focus on is Section A, origination charges. These are the charges that the lender has to show you what they're charging you for that loan. And they have to break it down. You see the junk fees here, and then the points that they're getting for that loan. This is what the section that you want to use to compare apples to apples, because some unscrupulous lenders out there will purposely lower their estimates for things that they know are low in order to appear more competitive. Again, that's why you want to go with someone that you trust, right? They walk you through all these fees, what they really mean, if they're giving you a true, accurate estimate of what those specific costs are going to be. If you need a second opinion, happy to review your loan estimate for free. We can walk you through all those charges and tell you where they're coming from and whether it's accurate. And it'll give us a chance to meet or beat those rates, right? It's no cost to you to shop lenders. So why Veterans Lending Group? And then we're almost done, guys. There's no minimum credit score requirement with Veterans Lending Group. Like many of the lenders will have a minimum credit score. We offer free credit counseling. If, number one, you don't quite qualify yet, we can help you get your credit where it needs to be in order to qualify, and we'll stick with you. We don't charge for that. We can do soft credit pull approvals, meaning that it won't impact your credit score when you're trying to get pre-approved. We only do a hard pull once you're under contract in order to finalize things. We have no lender fees, unlike any other company. Again, on that $500,000 home, that could be as much as $71.25, right? Most of us are available nights and weekends. Right now, it's 6:15 my time. I'm here teaching. Most of us are available nights and weekends, although we do ask that if you have a question or you want to discuss something, that you text rather than call if it's a night or weekend, because if it's something simple, we can respond pretty quickly. But if it's something more in depth that you need, we can set up a time to talk. It's just our families will thank you. It's like we all have lives. We have kids. I have a grandson that comes over all the time. I really enjoy my time with him. So texts are always better if it's night and weekend. But also, we work really hard to build trust in our communities by being transparent, by providing free education like this, because other companies, they'll just spend their marketing budget on advertising and just trying to get leads, right? We feel the better approach is to spend our money to educate our communities, to help them understand their benefits, so then and build that trust, because when they're ready to come to us, we've already built that trust. And then we are earning your business, but we're also earning referrals, right? It's just something that is the lifeblood of our company, is service. And then finally, there's no cost, no obligation, no risk, because we don't charge you a dime. The only time we get paid is when you close on a loan. Everything else that we do, all the credit counseling, walking you through loan estimates, education, all this stuff is completely free. We don't charge you anything. And if you wanted to get a second opinion or a different offer loan estimate, we're happy to do that for you. It doesn't cost you anything. So there's no risk to you. So part 4, and then we're going to get right into the Q&A after. So this 5-step process, take notes or take screenshots. First thing you want to do is meet with a lender and apply. The reason why I say that before you meet with an agent is because an agent loves nothing more than to have a pre-approved buyer, right? To have gone through that process already, that they're ready to shop. Then the realtor knows that you're serious and you're not wasting anyone's time. So meet with the lender and apply. You're going to meet with the VA home loan specialist, again, even if it's not us, right? You want to meet with one you like, you trust, and has a ton of knowledge about your benefit. What we're going to do is we're going to issue you a pre-approval letter. Basically, they're going through the entire loan process, right? Because we want to make sure that there's no hiccups along the way, that you can shop with confidence, right? So it's going to be a detailed review of your entire financial situation. We're going to document and verify all the information that you submit to us and get you approved for a loan. Pre-qualification letter, some other lenders and banks will do this. This is the shortcut method. Basically, this is a much more surface review of your entire financial situation. Things are not documented, they're not verified. And the problem with the pre-qualification letter, even though it can be done fairly quickly, is that if you shop with a pre-qualification letter, you can still get denied for a loan because they haven't verified anything that you submitted, right? They're just basically taking you at your word on your entire financial situation. So be very careful. Realtors prefer pre-approval letters, and sellers highly prefer a pre-approved buyer, right? Once you get that pre-approval letter in your hand, that's when you connect with the real estate agent. Again, you want to connect with one that knows the VA process, because that appraisal and the timing of that stuff is really, really important, that understands your needs, that listens to you. So ask them a lot of questions about the process. And then you want one with strong negotiation skills that can actually earn their fee, even though in many cases you won't be paying it, it'll be seller paying it, but even that's changing now. But you want to ask a lot of questions through the process, right? And then once you find a home that you like, make an offer. And then part 3, step 3 is mutual acceptance. This is when the seller and the buyer come to an agreement on the terms. The seller can accept the offer or counter and things like that. But once you come to an agreement, you're going to sign. That's when you sign your initial disclosures. It's all the documents and information you are required by law to receive in terms of the loan, all your rights, responsibilities, things like that. And you're going to order that VA appraisal we talked about. And the timing of it will depend on your specific circumstance, and we can get more into that in depth later. Note that the VA appraisal, again, is not a home inspection. What it's looking for is those 3 things, right? Other than assessing the fair market value, it's going to look at safe, sanitary, and sound, right? Whereas a home inspection is a completely different animal. This is a detailed review of the property on all the deficiencies. They're going to give you a report that lists all the things that are deficient in the property. But you can then use that document as a negotiating tool to negotiate better terms with that seller, right? You can ask for concessions. You can ask for them to repair what needs to be repaired. You could ask them to give you compensation, paint and carpet allowance, give you stuff like that they're not going to fix, but they could give you credit and lower the cost of the purchase price of the home. It's a great tool. Home inspection is really in your best interest. Both of these are, the appraisal and the inspection. Step number 4 is do nothing. Now, you would think that this is the easiest step, but in fact, for deals that go south, this is usually where the deals go south, because people get really excited about buying that new home, right? So sometimes they'll buy a car, they'll start furnishing the kitchen, the fancy new fridge and things like that. If they start getting into new debt, that new debt could negatively impact their credit. It could negatively impact that DTI, that ratio that we talked about earlier. And think of it this way, you are pre-approved based off of your financial situation at the time that you applied. If things change for the worse from the time that you applied up to the time that you close on the home, you could actually go from being approved to no longer approved for that loan. So you could actually lose that home. And nobody in this transaction wants that to happen, right? Everyone just puts so much time and effort into making this deal happen for it to fall apart at this stage. So if you need to make large purchases, talk to the lender first. You could figure out a path forward, right? If your car gives up the ghost during this process, you have to have a car, transportation for work. You may look at temporary solution until you close. And then once you close, you could do your preferred method. But let's get you across the finish line before you do any major purchases. Step number 5. This is when you sign and close the deal, right? So you're going to sign all the documents required. It's going to be another stack, right? Just like when you in service, you signed all those papers and signed your life away. Basically, it's the same thing, but now you're actually receiving an asset, right? And then you're going to close a deal. In some states, they may have a separation of 24 or 48 hours from the time that you sign all the closing documents to where you close the deal. So here in Colorado, it happens same day or at the same time. So we sign the docs and we get the keys to the home. And this is where the loan is funded and dispersed and everyone gets paid. And you are now the proud owner of a new property.